Hey friends, we're going to talk about the Vix curve today and why that can help you significantly make better decisions on timing as it pertains to your investing ideas. Hi, my name is Josh. I'm one of the founders of Miiflo, your daily flow of institutional class investing ideas. And what I want to do today is I want to walk through with you a mechanism that institutional professional traders like myself use to express risk in markets and to time the markets. I know a lot of people talk about not timing markets, but that's because they don't have the tools that the institutions have. And so I believe that if you have those tools, you would be able to make those good decisions as well. So let's walk through it, shall we? We're going to look at a chart here. There's a couple things on this chart. We're going to break them out and then walk through and give you some better understanding. But we're comparing kind of two things. At the top, we just have a line chart of the SPY, which is the ETF that tracks the S&P 500. In the bottom, we have a graphical representation of something to me that's called the Vix curve. And what this is this is the relationship of volatility over multiple expirations in time. And it's built around a key principle that we look at when it comes to markets. And that is the only fundamental that really matters, that you can really lean on, is how are market participants positioned. So not earnings statements, not macroeconomic events, but it's really how are those that you're competing with in the space, how are they expressing risk as a whole that can give you insight into what the likely group behavior is in a specific window. And options, which Miiflo looks at all the time, is a way to see that, because that's another fundamental, is that the options, kind of the tail wags the dog. So per this fundamental that behavior drives the markets, the key behavior that drives the markets is that markets will rally when everyone's bearish, and they will fall when everybody's bullish. It's kind of the, when you can see a trend, you have to wonder how much of the trend is left. So when you see something going down, you have to go, well, how much is there to go down? And when we go up, how much is there to go up? Now, the specific mechanics that drives that is how participants in the market are buying protection to the market, specifically buying puts. So a put is a vehicle, an option that you can buy against your portfolio that can protect it on the downside, because that put will appreciate in price over time. And investors will use different expirations of puts because they don't want to pay too much for their puts. And so we can see this behavior in this curve, and it can help us time what's going on. So we're going to come back to this chart here in just a second, but I want to actually go and look at a couple other things, and then we'll go back and explain this. First thing. So this is the SPY, same chart, but below here, we've broken out the price indexes of all of these different volatility expirations. When somebody talks about the VIX, which is an index that measures risk, what they're really talking about is they're talking about a 30-day window. Now, there's risk outside of 30 days. Some risk is nearer than 30 days, and some is much further out. So there are a number of indexes. There's the VIX 9-day, there's the VIX, which is 30 days, there's the VIX 3-month, 6-month, and 1 year. Okay. Now, as is the case with most probability-based events, the further out in time I go, the more could happen. And therefore, the premium that would it require to cover that period of time would be, on average, more expensive. Okay? It's similar between paying term life insurance for or a specific period of time versus whole life, which is over whole time. You're going to be able to pay less doing the term because it's a shorter risk window. Same thing happens here in equity markets. And so you can see the relationship, the ebb and flow between these different expirations over time. And you'll see there's actually times when that 9-day VIX, that light pink, actually is priced higher than volatility on a 1-year basis. In fact, the whole curve kind of goes like this. So that's what we call an inverted Vix curve. And specifically, we're looking at the relationship of 2 of these or 3 of these expirations to each other. One is 9 days versus 3 months, or versus 30 days, which is the VIX, and then 9 days versus a year. Because when participants are paying so much for their risk in a 9-day window that it's more expensive than a year out, we're getting to that period of time when everybody who's going to buy protection has bought it. And then once nobody else buys behind that, then we'll rally. Okay, so going back over to this chart, the red line represents the relationship between the VIX 9-day and VIX 1 year. The blue line is the VIX 9-day and the VIX 30-day. Okay, And this parity line is where is kind of the measurement of how bearish are we. When we're above that line, everybody's really bearish. Now, note the behavior of the auction, of the market, whenever we get above this line, okay, and then get back below it. When we get above it, the market's going lower, but then once we revert back, the market moves higher. We're going lower until it reverts, and then the market moves higher. We're going lower into it, and then the market moves higher. We're going lower into it, and the market moves higher. We're going lower into it, and the market moves higher. Why is that? What's happening here is that when people are buying puts, someone is selling those puts to them, and that's often market makers or dealers. Now, that market maker or dealer who's providing the other side of the trade will do something else. And what they do is they will go and hedge their exposure to the market because they actually don't want a directional exposure. And they will hedge that so that they create what's called a delta neutral position, meaning that their P&L doesn't change whether market moves higher or lower because they got paid when they facilitated the spread of the trade to you at the beginning. So then all they will do is they will monitor how much hedging do they need. Well, here's the thing about options that we know is that options, if they're not monetized quickly and they become out of the money, over time they lose value. What is this value that they lose? Okay, if we go over here and look at an option chain of the SPY, what they lose is their extrinsic value. So for example, look at the 398 put today has $4.20 per share of extrinsic value. That's 3 days out. Look at 30 days out or 38 days. That same put has about $11.61 of extrinsic value. So if we're not trading below 398 by expiration, that extrinsic value goes away. That's the extrinsic value is the portion that what we call gamma that market maker or dealer has to hedge against. So if that starts to shrink, then they need less hedging. And if they're selling futures to offset the risk of those puts, if those puts start to decay and require less hedging, guess what they will do? They will buy futures. And it's that buying that raises us higher. So in this specific instance or of this year, 2022, where we've seen some pretty significant rallies, be aware that those aren't institutions or long-term investors who are buying dips. That is most likely what we call a responsive Vanna rally, for another conversation, where the dealers are buying back their hedges because those puts are evaporating. Okay, we can use this as investors to make better decisions, especially around the timing. So like today, if we're in an area where we've got a curve that is slightly inverted, this is what we call a mixed curve. So the near-term curve relationship is inverted. So they're definitely hedging up, but that longer term curve isn't quite there yet. What does that mean? It means we're still susceptible to the downside and we really don't have a good holdable bottom yet. And that means that this market can continue to push lower until we can get this whole curve inverted. Now, once it inverts, then we're watching for reversion. And once it reverts, then our idea is to be long a period of time until which time it inverts again, which is typically on a monthly or 3-month cycle based on when options expire. So in this case, we have a significant options expiration that's coming up at the end of the month that actually marked the low here. This was a big options expiration. So if we can get this market up here and get all the hedges in before options expiration and then options expire, then we'll see a rally after that. If we don't have that in place before the options expire, then we're still susceptible to the downside, and that can just help us in our timing. And this is the aspect of where we believe, hey, if you've got these tools and now seeing this and now understanding that this is a little bit like physics, right? Like if I take an apple and I throw it in the air, yeah, I can beat gravity for a little bit, but then gravity is going to come back down. So there isn't some magical, mystical ball here. If you have the right tool to be able to see how people are behaving, we believe you can make better decisions. And it's this kind of insight that Miiflo gives to its community every day. So That is the Vix Curve. You can get more ideas around that at miiflo.com. Have a great day. Let us know any questions or comments.